Hey everyone, so just a 5-minute warning. In about 2 minutes, I'm going to share the welcome screen and then I'm going to start the webinar. So please just make sure you keep your mics off and just keep watching. Good luck everyone.
Good afternoon, and welcome to the second of a series of specialist webinars delivered by KPMG. I'm Malcolm Braybon, Head of Services at Coaster Capital LEP and Growth Hub. The LEPs and Growth Hubs of Enterprise M3, Thames Valley Berkshire and Coaster Capital have come together with KPMG to provide a series of webinars on key post-Brexit transition related matters. Growth Hubs have been delivering COVID-19 and Brexit-related support during the whole of 2020, and towards the end of last year, received additional funding from the government to help address key issues related to our departure from Europe following the end of the transition period. Collectively, we've supported over 10,000 businesses through this additional engagement of specialists and generalist advisors, and advisors for outreach and advice. The South Central cluster of LEPs are 4 of the 38 LEPs located across England. They are local, business-led, multi-sector partnerships mandated by government and play a central role in determining local economic priorities and undertaking activities to drive economic growth and the creation of local jobs. The LEPs fund, manage or deliver the Growth Hub services which support business growth. The Growth Hubs offer a fully funded, impartial support service and expert advice to all small and medium-sized enterprises. The service provided by each Growth Hub provides a range of support. We have access to a wealth of information, advice, support services and events, all free of charge. We can also help you connect with a network of local and national programs and organisations. So do have a look at the Growth Hub websites. There's a lot of additional information on those and details how you can access the support. In addition to KPMG's areas of expertise, the Growth Hubs are able to provide support related to other post-Brexit transition questions you may have. We're delighted to have partnered with KPMG in developing this key set of webinars to support businesses across our area with their post-Brexit transition. As well as hearing from experts in their field, there's an opportunity for you to be able to ask questions related to the topic. Today, KPMG are focusing on VAT and customs, which make up a high percentage of the questions asked by Growth Hub and KPMG clients. The third and final session is being held on the 31st of March and will be covering legal considerations and how to navigate immigration in a post-Brexit UK amid a global pandemic. Without further ado, I'm delighted to introduce our chair for today, Joe Wolstenholme, who is KPMG's Head of Business Development, Corporate South. He leads their services team across the South region, coordinating KPMG's services to FTSE 350 and corporate clients. Joe.
So much, Malcolm, and good afternoon, everyone. I'm Joe Wolstenholme, as Malcolm kindly said, from KPMG, where I lead our consulting support in the South region. I've also had the pleasure of project managing this collaboration with Platform 9 to host the series of 3 webinars, of this being the second, focusing on Brexit and the implications of the deal. It's been a pleasure to partner with Coaster Capital, and we've enjoyed hearing from many of you throughout the webinars. There have been a broad, diverse mixture of businesses, some with shared challenges and others with unique ones. Now, before we get started, a quick bit of housekeeping. We'll be using the Q&A box today for any questions you'd like to ask the panel. So please feel free to upvote any you're particularly interested in. We'll make sure that we get to the most popular. Excuse me. For any general chat and discussion, we'll be using the chat box. Neil and Kate will also have access to the chat box too and be in there. We'll also be recording today's session, and it will be we'll be posting the link to where to find it in the chat box. It would be also useful if you could let us know in the chat box which industry sector you're from. Now, without further ado, I'll hand over to Neil and Kate, who will take it from here.
Thanks a lot, Joe. So good afternoon, everyone. My name is Neil Whedon. I head up the indirect tax team in the South. And today I'll be joined by my colleague, Kate Clargo, who's our resident trade and customs specialist. To give you a little bit of background, I've been with KPMG now for over 20 years. Since the announcement of the referendum in 2016, I've been very heavily involved in advising businesses on Brexit, and now very much involved in helping people implement any necessary changes or deal with the issues that they're encountering since we exited the EU on the 1st of January. So the purpose of today's session is we've pulled together some slides that we're going to talk through. What we're going to do is we're going to do a bit of technical detail, and we've also overlaid with some supply chains. So if you do have questions that we go through, we have tried to address some of the questions that we know have already been raised, and also built in some of the common themes that we're already seeing coming out from the type of advice that we're doing with our client base. So look forward to receiving your questions, and let's get started.
Thanks, Neil. So we thought it would be helpful before we get too much into the detail to run through some of the basics of customs, particularly for those of you that might be dealing with customs formalities for the first time. Movements of goods across international borders trigger customs processes. So that's declarations, controls, for example, health certificates or export licenses. It triggers tax payments potentially, and duty payments, etc. So prior to January 1st, we benefited from free movement of goods thanks to the single market and the customs union. But now we all have a lot more administration to manage when trading with the EU. It's really important to appreciate that there are two declarations, and this may seem obvious to some, but you'd be amazed how many people don't quite appreciate this. So there's an export declaration and there's also an import declaration. And whilst they'll likely be very similar because they're for the same goods, you may see some differences. For example, the values being declared or the classifications that are being used. Generally speaking, you will see the tax and duty only being triggered on the import declaration and not the export declaration. So there are sometimes some quite confused discussions with customers or suppliers when both have maybe slightly different demands at export compared to import. And then the final point here, the importer and the exporter is the person, or the importer or exporter, they might be the same, is the person who's legally responsible for the accuracy of the customs declarations that are lodged. Many traders will be using agents to submit the information on their behalf, but it's really, really, really important to remember that it's up to you as the importer or the exporter to provide them with the information that they need. And not only that, but you also need to verify that what they've been declaring for you is accurate. As we'll come to discuss later, in the majority of cases, the agent is not actually at all liable or on the hook with the authorities when it comes to issues with those declarations. That's another point I think that I think a lot of businesses think my agent's taking care of this, it's all absolutely fine, which unfortunately isn't the case. Neil, did you want to make any VAT comments on this kind of the general movement before we move on?
Yeah, I think that the most important thing to note from a VAT perspective is now that we've left the EU, the UK is no longer governed by EU VAT law. So we now have our own set of rules. And whilst at the moment they remain largely unchanged, it's likely that we will diverge from the EU set of rules as time moves on. And the other thing to bear in mind, even about EU VAT law, is whilst it's supposed to be harmonised across all the 27 member states, in reality, it's often far from harmonised. And you can typically find that different member states and tax authorities in different member states will apply different interpretations to the rules have their own unique set of conditions that they apply to certain processes. So unfortunately, it's not a case of one size fits all when it comes to dealing with the EU. So businesses dealing in the EU and the UK now have the increased complexity of having to understand and comply with two completely different sets of rules in some circumstances.
Okay, so customs duty. So for many businesses, one of the key Brexit impacts is around this additional cost to the business. Customs duty is a sticking tax, so unlike import VAT, it's not recoverable. So it's really important that you understand how it's calculated and make sure that you're not either underpaying and therefore getting in trouble with the authorities, but also you absolutely don't want to be overpaying because that will impact the cost of your goods. So to understand how customs duty is calculated, we look at these three key customs pillars that apply to the declaration of goods to customs authorities. So we have valuation, classification, and origin. First of all, classification, or the commodity code. And the commodity code will determine the rate of duty, which is often charged as a percentage of the value of the goods. In addition, the commodity code might determine whether or not the goods are subject to sanctions, to retaliatory duties, and also whether or not the goods can benefit from trade agreements. So when we're thinking about this post-Brexit world, the commodity code really is that kind of building block to understanding financial impacts, but also when you're looking at the trade deal and whether you can benefit from it, you need to make sure that that commodity code is right before you take any more steps. Next, valuation, which is of fundamental importance. It's the fiscal basis for levying the amount of duty and also import VAT that you're paying. The basic principle of valuation requires that the customs value of goods is based on the actual price paid or payable for the goods, which is generally the value that you'd have on the commercial invoice. Another common misconception or a common question that we get asked, can goods have a zero value if they're free of charge or if they're just a replacement being issued to a customer, for example? But goods will always have a customs value. And that's really important that you get that value right, as I said, because that will dictate the level of tax and duty that you're paying. Sorry. Then finally, we have origin. Origin is obviously being talked about a lot at the moment, as I've already touched on, because of the trade agreement. So many importers consider that the origin of their goods is the country that the goods were shipped from. However, origin in the customs sense is considered as the country in which a product is grown, manufactured, or where it undergoes substantial transformation to change its nature. Origin assessment is unfortunately quite complex because there's specific rules that vary depending on the destination, depending on the trade agreement, etc. But if you use origin correctly, then it can be a really great mechanism for potentially reducing that duty liability that you have to pay. So these three customs elements really are super important for managing that duty bill that you might have to pay. Here we have got a copy of a customs declaration, and we've just highlighted some of the key data fields. Some of you might already be quite familiar with this type of documentation if you're already dealing with international trade. Some people may never look at these because it'll be your agent often that's completing this on your behalf. But we've just highlighted some of the key boxes. So on the top left here, we've got the consignor, so that's the exporter. And then we've got details about who's importing, who's declaring the goods, details about the goods themselves, and then details about the calculation of those taxes. So obviously if you're wanting to check what you were paying and what those goods were, then this is really important to be able to check back and verify. On the right hand side, the box one, the declaration number, if HMRC are ever in touch with you to ask any questions about an entry, then that's the number that they will reference. We've then got the country of dispatch, box 15. And then there's another box further down, box 34, which is the country of origin. And as I just mentioned, the country of dispatch and the country of origin will not necessarily be the same. In fact, often they'll be different. We're going to talk a bit later in the context of some supply chains, and also a bit more technical background about what you need to do to determine that origin. And then finally here you can see the commodity code that I just mentioned, the value. And then at the bottom here, the final box I'll just highlight is something called the Customs Procedure Code. You might hear that being referred to as the CPC code. That code's really important because that will tell the customs authorities how to treat your goods. So are they being cleared for free circulation and you're just paying duty and taxes straight away? Or are you claiming a relief, like return goods relief or inward processing, or entering your goods into a customs warehouse? These are some of the kind of reliefs that we'll talk a bit more about as we go through the session. But it's just important to appreciate that all of this information, like I said, it not only tells the authorities how to treat your goods, it will inform how much duty and tax you're paying. And it's this kind of information that you need to make sure you have some kind of control over, because whilst your agent might be submitting it, you're legally responsible for that declaration. And obviously as a business, you have an interest in making sure that it's right.
And Kate, I think it's it's true to say as well that quite a few of the instances of where we see goods again held up is because declarations haven't been completed correctly. So understanding the data that you're required to provide your agent is really important to ensure that those declarations are filed correctly and accurately first time, because that is also going to make sure that your goods aren't getting held up at borders unnecessarily. Absolutely, absolutely. So, like I said, we're going to talk through some kind of basic supply chain scenarios and overlay what's changed since the 1st of January. So we kind of start with the basics. Is obviously now, because we trade as a third country, we're no longer part of the EU customs union. So movement of goods between the UK and the EU are treated as imports and exports, which means that import VAT is payable on goods entering the UK from the EU and vice versa. Now, that lies in, you come on to the importance of Incoterms and contractual terms, because that will determine who has to pay that import VAT, and importantly in my world, in the world of VAT, who is entitled to reclaim it. And the important distinction to draw there is Incoterms is a logistical set of terms that determines when certain title and risk and cost transfers from the buyer to the seller. What it doesn't set out is when ownership of the goods transfers from the seller to the buyer. Now, in the world of VAT, that's quite important because the UK HMRC released guidance earlier in the year, and it was clarification guidance, it's not new rules. Making it very clear that only the owner of the goods at the time of import is entitled to recover the import VAT paid. And a number of EU member states have kind of followed suit since and released similar guidance. In some member states, I mentioned it's not harmonised. In some member states, it's enough just to have some sort of economic interest in the imports to be able to recover the VAT, but in most, it's only the owner of the goods at the time of import that can recover the VAT. Now, the reason I mention that is we do come across instances, and we are coming across instances of where the Incoterms and the contractual terms aren't aligned, and that can then create the risk of potentially creating a trapped import VAT cost, or the wrong entity recovering the import VAT. If you're a UK business importing goods into an EU country, again, Incoterms is really important because there's a lot of pushback at the moment. So a lot of EU customers are pushing back on suppliers to deliver goods on what's called duty to deliver paid Incoterms. Kate will cover that in a bit more detail in a few minutes. But as a rule of thumb, if you're delivering goods under DDP Incoterms, then that also means that you're most likely going to have a VAT registration liability in the EU country of imports, and then a requirement to charge domestic VAT in that country. And once registered, you'll have to comply with all of the rules that come with that. There are exceptions, because there always are. There are certain countries that operate simplifications that mean you don't actually have to register, because the import itself doesn't trigger normally a liability to register. It's what happens afterwards that gives you the requirement to register. Because we're no longer part of or governed by the EU VAT directive, that means UK businesses can no longer take advantage of the EU VAT simplifications that exist. The ones we come across most commonly being the call-off stock simplification and triangulation. I will just go into one of those in a bit more detail in a moment, just to illustrate how that actually impacts businesses. And also for B2C supplies, there are some new rules coming into effect on the 1st of July 2021, some simplifications. So if you're a UK business selling direct to consumers in the EU, then there is further rule changes to be looking out for. The also important thing to note when you're looking at supplies to consumers, so non-business customers in the EU, is who is the importer of record of the goods into that EU country. If it's you as the business, then I said likelihood you're going to have a liability to register and charge VAT. If it's the customer, then they're actually responsible for importing the goods, and you need to factor in the associated import costs into your pricing to make sure that you're not eating into your margins. There is also some potential further benefits to the business being the importer in terms of returned goods. So if you have high level of returned goods coming back to the UK, it is worth thinking about whether you want to be the importer of record rather than the consumer. In terms of the customs elements, in order to import into the UK, you require a UK EORI number, and likewise to import into the EU, you require an EU EORI number. Kate's already covered the importance of classification, and we're going to go into that in a bit more detail, because that will actually drive a lot of the duty position. And then also looking at, in the nature of the goods that you're trading, can you actually benefit from the trade and cooperation agreement, as it's called, that was being entered into between the UK and the EU. So there is a lot to think about, and there are differences whether you're dealing in B2B or B2C supplies.
So classification. So one of the points of thinking about importing, and one of those key customs pillars is classification. And actually, kind of well timed, one of the questions in the Q&A right now is about classification. So you read our mind. So as I said, classification is really important because it will influence the level of duty that you're paying, and also it will drive certain other treatment of the goods. So for example, it might trigger that certain certifications required, that licenses are required. So it will indicate to the customs authorities how exactly those goods should be treated. As I said, really this is getting your classification right is one of those things that it's worth spending a bit of time on, and definitely not relying on your agent or just relying on kind of, I've heard businesses before use the term kind of bulk classifying, or just classifying it in what we call kind of a bucket other classification. Not only could that mean that you're paying the wrong duty amount, but fundamentally it's just not the right approach. So we're just going to talk a bit about what the process is for classification, and I will answer the question that was raised on the Q&A at the same time. We've made the point here on the slide that even when you've got a 0% duty rate, so some sectors, like for example, technology, pharmaceuticals, their products are often duty free. But even if you're one of those lucky ones, I guess, that don't have to worry so much about duty, you can't ignore classification because of all of those other elements that it can influence, and also because it's a legal requirement to make sure that you get it right. So you do need to give it some attention even when there isn't duty at stake. So we've listed out here the various different impacts that classification have. At import, obviously, as I mentioned at the beginning, this is where we see that tax impact in terms of the duty. You might also see additional duties that are triggered, or also you might find that there are certain quotas or tariff suspensions depending on the commodity code. And then at export, there isn't the same duty impact, but it's still important that you get that classification right because, well, first of all, because the importer at the other side might kind of use your commodity code as a basis, but also it's used for trade statistics purposes. So the authorities will still be interested in making sure that you're accurately classifying. Neil, if we could go on to the next slide, we've got an example of what a classification looks like. Oh, no, we don't.
Here, sorry.
Here we go. No worries. So one of the questions that was raised on the webinar last week was around the number of digits that you need. So there is a different requirement at import versus export. So at import, you have to classify up to 10 digits, whereas at import, it is 8 digits. The classification system itself is based on something called the harmonized system, which is operated by the WCO, the World Customs Organization. And what that system does is it provides a logical structure and framework for classification up to the 6-digit level. So what you'll find is that with all members of the WCO, of which there are over 200 countries, you'll see that up to that 6-digit level, you will see a commonality in classification. But beyond that, so up to the 8 digits and beyond, you might see that there are some differences. Obviously, at the moment, we're quite closely aligned with the EU because we've only just left. But I suspect over time, we will see some differences, particularly at the 10-digit level. So when you're importing into the UK now, you're paying your duty and you're classifying according to the UK global tariff, whereas when you're importing into the EU, you're using the EU external tariff. So we do now have 2 different trade tariffs that we're looking at. But like I said, they are fairly closely aligned. So that WCO 6-digit level is really useful because obviously there's an element of harmonization globally. It's a really good start point if you've got a supplier, for example, sending you goods from the US. You could, with some comfort, obviously you'd want to verify it, but that up to that 6 digits, in principle, it should be the same. What the WCO also does is it sets out something called the GIRs, the General Interpretive Rules, of which there are 6. Now, we're not going to go through those today, but just in response to the question that's on the Q&A. So the question on the Q&A is, how do you identify the correct commodity code as many goods could qualify for several? Which is a really excellent question. Now, what one of those rules says is that you have to classify your product according to the most specific description. So in the example that you've given here, where we've got a video game, that could be a game or electronics, there might be multiple places. If there is a description that specifies a video game as opposed to electronics or just a game, you would classify it according to being a video game because that's the most specific description. Obviously, sometimes it's not quite as clear cut or obvious as that, but the temptation, particularly when there is a duty, so you might be paying, I don't know, 6% duty for one classification, 0% for another. The temptation is to try and make that fit to that description where you're not paying any duty. But unfortunately, you do have to follow these rules and classify it according to the most specific description. You'll also see, so in the tariff, there are some explanatory notes. So for those of you that have accessed on gov.uk website, the UK tariff, when you're on a commodity code, if you scroll all the way to the bottom of the page, there are some explanatory notes and they set out certain descriptions and explanations. So that can be really helpful as well in directing you. But this is just, I could talk about classification for a very long time. So if anyone has any questions, please put them into the Q&A. But this is just kind of a high level introduction to show you what the commodity code looks like, the difference in terms of the digits, and just to highlight the fact that there is a framework that you should be following. So that's definitely something, as I said, to spend a bit of time on making sure you've got right.
And Kate, a question's literally just popped up about getting rulings on classifications from HMRC.
Yeah, so another good question. So we have a tariff ruling system in the UK. It used to be called the BTI system, which is the European system. The UK now has its own. So you can absolutely, if you want certainty, you can get a ruling from HMRC. You don't have to. There's no legal requirement that you have to get a ruling. I would say that the times where it's best to get that certainty is when you're in one of those grey areas that I was just describing, where actually the difference is really very material. You don't want to be paying 0% and then realise that in 3 years' time, HMRC can go back 3 years. You don't want to set yourself up for having that liability. So I would say in those kind of scenarios, then absolutely a ruling's the right thing to do. But certainly don't feel like you have to do it for every commodity code, because also HMRC, if they rule against you, then you're stuck with it. And it would take a very long time, I think, to get all of those rulings back. So those grey areas, it's definitely worth approaching HMRC. And there's a special online system that they have for that.
And Kate, just a quick one for me, because I know we've had these questions as well before, is those rulings, are they binding for EU customs authorities as well?
They used to be, but obviously not now. So now it's just the UK. And actually, if you held a BTI prior to the end of 2020, HMRC will have got in touch with you and said, you've got the choice. You can either carry it over into the UK system or you can start again. So I know some businesses that took advantage of that because they had a ruling they maybe didn't like, but obviously now. So you can still use, the EU has an online system, a BTI database, which can be really useful to look at and just see what other people have classified their products as. It can be a good start point, but yeah, unfortunately, we're on our own now. It's just the UK.
So thanks, Kate. So as I mentioned in my slide previously, one of the impacts of us, the UK leaving the EU, is the lock-up to the VAT simplifications that exist under EU law. One of the ones I mentioned is triangulation, because it's something we come up across quite commonly. So what I'll just do is, so obviously prior to the 1st of January, UK supplier, still UK was in the VAT system. So if you had UK supplier sells goods to a customer, an EU customer, and let's say it's member states 2 in my example, sorry, member state 1, and then that customer in member state 1 sells it to their own customer in member state 2, and the goods were shipped directly from the UK to member state 2, then the triangulation simplification meant under normal rules, UK supplier would have a liability to register in member state 2, but the triangulation simplification avoided that, and it said instead that the UK supplier could treat their supply to company B in my example as a zero-rated supply, and company B could treat its supply to company C as a zero-rated supply. The requirement there being, in order to use triangulation, is companies A, B, and C cannot be established or registered for VAT in the same member state. So if you had, in my example, company B and C both in France or Germany, say, then you couldn't use triangulation. And that continues to be the case, obviously, post-January, because triangulation continues to operate in the same way as it did for EU VAT-registered businesses. So what's the impact of that in terms of post 1st of January? Because it cannot be used, that means that now UK businesses have a potential liability to register for VAT in member states 2, where the goods are actually being sent to. And as I mentioned at the start, it's going to be Incoterms and contractual terms that are going to determine whether the UK business has a liability to register for VAT in that member state, and indeed who's entitled to reclaim the import VAT payable in that member state. So if you took advantage of a triangulation previously, then chances are you've now got additional EU VAT registration liabilities. And if you're entering into new supply chains and you're looking at the invoicing, do not assume just because you've got 3 different countries involved that the triangulation can still be used. So it's just another added level of complexity. I've just seen a question pop up about the new rules for B2C supplies that are coming in July. I am going to touch on those. I'll touch on those a bit more at the end, if that's okay. So I touched on Incoterms briefly a couple of times, so Kate's just going to go into that in a bit more detail.
Thanks, Neil. So as Neil said, we've touched on Incoterms a few times already, and it's because really the start point for all discussions about trade really is the Incoterm. What is the Incoterm that you've agreed, or what Incoterms do you want to agree, because they will set out the key terms of that transaction. So what Incoterms do is they perform the function of being a shorthand for who's responsible for what in the delivery of those goods. They were established by the Chamber of Commerce way back in 1936, and they're renewed every few years to keep up with changes in international trade and transport practice. So we have the most recent change coming to effect this year. The purpose of Incoterms is to minimise misunderstandings over commercial terminology. So they define who's responsible for loading, for the transport, for insurance, and they define the point at which risk transfers from the seller to buyer. And importantly, obviously, they also define who is responsible for the export, who's responsible for the import, and therefore who's paying those duties and taxes. There's a few things to remember with Incoterms. So they don't have any bearing on title transfer, which is really important when we think back to Neil's point earlier about right to recover import VAT. So Incoterms won't determine that, so you can have a bit of a conflict sometimes in terms of who's owning the goods at the time of import and whether or not that entity can recover that import VAT. So that's just something to be mindful of. Incoterms obviously don't cover everything that might be in the contract for sale, so currency, method of settlement, etc. They really are just to do with the delivery of the goods. Incoterms are meaningless without a named place. So it's really important that if you say deliver duty paid, you say deliver duty paid where to. And final kind of cautionary comment from me, I guess, is make sure that make sure there's no contradictions between your Incoterms and what's in the contract. It's not uncommon for us to see the contract saying one thing and the Incoterms saying something completely the opposite. So obviously that can lead to issues if there is any kind of dispute. So just make sure that you are aligned and that you understand what you're agreeing to. Obviously, lots of businesses at the moment are going through the process of renegotiating contracts and redefining Incoterms for their trade with the EU, because historically it didn't mean anything really, because there were no customs formalities, whereas now obviously there is a lot more significance. And for the first time, really, we've got Incoterms because of Northern Ireland, which we'll talk about a bit more later. You've got Incoterms for domestic movements that now have an impact on roles and responsibilities as well. So it's definitely something to make sure that all parties to the agreement understand their obligations. On the next slide.
Oh, I was just going to say, Kate, I was just going to flick back one quickly, because a question came in about on the triangular supply chain, how do you get goods to company C in this type of scenario? And it does link into the Incoterms. So the absolute optimum position for a UK supplier here would be to sell to the intermediary, so to company B in this scenario, on the high seas. So, and then for company B to be the one responsible for importing the goods into the EU. So you'd have the Incoterms set that it's actually company B that's going to be importing the goods, because then what that's doing is, as a UK supplier, you're just saying, well, the only supply you're making is a zero-rated exports, and that's where your responsibility stops. And the additional benefits of that being is company B, if it's EU established, that means they don't have any of the potential customs representation issues, which Kate will touch on in a bit, in terms of importing the goods into the EU as well. The other alternative is that as the UK supplier, you have to be responsible for importing the goods into Member State 2, where Company C belongs. But that potentially creates a VAT registration liability for the UK supplier and the intermediary, so Company B, because what will happen then is UK supplier would have imported the goods into Member State 2. It will, you will then make a supply of those goods to the intermediary, so Company B, who then in turn will make a supply to the end to Company C. So actually that could create two VAT registration liabilities. So it is in the intermediary's interest as well to work with you and be the importer, because it potentially makes life simpler for them as well. So there is no simple answer to that. It's working with customers and intermediaries to come up with the best solution for everybody. Sorry, Kate.
No worries. So here we've got, so first of all, a comparison of the 2010 Incoterms and 2020, just so you can see there's a very small difference in a couple of the terms. And here we have got, you can see we go from one extreme of X works through to the other extreme of DDP. So X works, you have places the minimal responsibility on the seller. So the seller just makes the goods available to the buyer, and the buyer is responsible for the export formalities and everything beyond. Whereas at the other end with DDP, deliver duty paid, it is the seller that has to do everything. And now the reason why we've highlighted those two is because we would always kind of be a bit cautious of both of those if we see them. There can be challenges associated with them as a result of an overseas business having to be responsible for an export declaration, or vice versa with DDP, with being responsible for an import in, well, if we think of in our scenario, from the UK to the EU. And I know a lot of businesses are being put under a lot of pressure by their customers to agree to DDP Incoterms. It's probably one of our most common questions or grievances that we hear from clients, that they're getting a lot of pressure, particularly from customers that might have a really big buying power. And they basically just say, kind of do it or lose our custom. So therefore, there are challenges around that in terms of having to be the importer overseas and then also pay that duty and tax. If we could just go on to the next slide quickly. As Neil mentioned earlier, when it comes to customs representation, so the reason why DDP can pose the problem from a customs perspective, when I showed you that customs declaration earlier, you'll remember there was a box for the declarant and there was a box for the importer, the consignee. And if you are the declarant within the EU and also within the UK, you have to be established to be that declarant. Now, when agents are acting on your behalf, you'll find that often they're acting as a direct representative. So this is the option at the top here. And this is where they're lodging a declaration in the name of and behalf of the company that's the consignee. And so in effect, whilst you're using an agent, the agent the consignee is responsible for the declaration, for any taxes, etc. So they're not liable at all. So as you can imagine, a lot of agents are quite comfortable acting in that capacity because there's very little risk. But when we have a situation where a company is not established in a territory, they cannot be the declarant, and therefore the agent has to act in an indirect capacity. And in that capacity, they become jointly liable for any customs debt and also the accuracy of the declaration. And the reason behind that being that the customs authorities want to know that there's somebody that they can go to recover that potential debt, or if there's an issue with the declaration. And as you would imagine, agents are not as willing to act as indirect representatives. So in our discussions that we're having with clients, the real issue with DDP is around this need. Often, if you don't have an establishment in the EU, this need for indirect representation, and that really is the problem. Everything else you can kind of manage through kind of recovering the duty, or, you know, the rest of it is workable, but it's this, and this point is workable, but it's just something to be aware of and to plan for in advance. But if you're getting any pushback from agents in the EU, if you've got DDP Incoterms, then I suspect this is probably why, because there's this resistance to be an indirect rep.
Yeah, and I think it would be fair to say, wouldn't it, this is probably the biggest bump in the road that we've seen for most businesses, that UK businesses that are now importing goods into the EU. And what I would say as well is we're doing a lot of work with our kind of member firms in EU countries around looking at solutions and contractual ways of working around these kind of liability issues, so we can get goods moving again. And it's something, so if it is an issue, there are potential solutions, but it does require a kind of negotiation with agents.
Yeah, I've just seen a question come up about, can the Chamber of Commerce do some of this representation through their customs clerks? I'll be honest, I'm not 100% sure what the Chamber of Commerce does in that capacity, but I've not heard of any Chamber of Commerce doing this, because this is the entity that's actually lodging that declaration. I'm not aware that the Chamber of Commerce does that, but I may be wrong. So maybe we can pick that one up offline.
Yeah, the other thing I would just add for that as well before we move on is, in France, for example, it's possible to do things with an import declaration that it's not possible to do in other EU countries, and who you can actually put down as declarants. So again, if this is a kind of a significant issue or a critical issue, it is worth exploring what are the alternative solutions, because there are possibly and normally alternative solutions. So another complex one or another supply chain that we're seeing is creating a lot of complexity for businesses is goods that are being sent from the EU to the UK for repair. Now, from a VAT perspective, the key issue that arises here is, as I mentioned at the outset, HMRC have released some clear guidance saying only the owner of the goods at the time of import is entitled to recover the import VAT. So if you're a company providing the repair services, normally ownership of those goods won't kind of transfer to you. You're just bring them in so you can provide your services. So you, therefore, being the UK business, are not entitled to recover the import VAT that's payable on those goods when they arrive in the UK. Only the owner of the goods is, so whoever your EU customer is. So from a VAT position, the main risk is this import VAT recovery point, but there are more complications as well from a customs perspective.
Yeah, so obviously in this supply chain, we've got multiple duty and VAT points. You've probably paid duty once when you originally supplied the customer in the EU. You've then potentially got a duty point when it comes back, and then another duty point when it goes back again. So 3 duty points there. That ideally, obviously, you don't want to be having to pay duty on every single one of those. And in those scenarios, like Neil said, where you've got irrecoverable VAT, you don't want to have that exposure. So in this kind of supply chain, we would be looking at outward processing relief and inward processing relief. So from the EU, your EU customer would be using outward processing relief. So when that export declaration is lodged, when I mentioned about customs procedure codes, a specific customs procedure code is used to indicate that those goods are going out for processing or for repair. And then when you import those goods into the UK, you would import them, again, using a special procedure code for inward processing. And then what that does is it suspends the payment of any duty or VAT, and then either if those goods for some reason stay in the UK, then you pay it on the kind of repaired good or the processed good. But if those goods go back to the EU or elsewhere outside of the UK, then you wouldn't pay that duty or VAT at all. And then when your EU customer re-imports it, they only have to pay duty or VAT or both on the value add element. So they're not having to repay it on everything. Now, those authorizations, they do require you to get authorization from the authorities. You can use a simplified version 3 times a year up to a value of £500,000, but you do have to apply to HMRC in the UK and obviously the tax authorities overseas in order to benefit from that. And then there are certain compliance requirements. So there would be an element of cost benefit analysis that you'd have to undertake here in order to understand if that would be the right relief for you to be using. And then I've just seen on the Q&A, what if it is decided that it will be an exchange and a new product sent out rather than a repair? So when you submit your application for inward processing, one of the options that you can agree with HMRC is exactly that kind of scenario. So you could have, there's something called prior export equivalence, or just equivalence in general, where you can you could send out an equivalent good as opposed to the identical good. So that's something that you would apply for when you applied for the IP authorization. It doesn't have to be the same item. With things like inward processing relief and outward processing relief, then the key is traceability, really. And I've just seen we're kind of running out of time a bit, but Neil, I don't know what you think, but I think we'll carry on as we are and maybe reduce the Q&A session. So if people have got questions, because we're kind of answering the questions as we go, if people have got questions, please post them on the Q&A. I promise we won't go past, we won't go on too much, but I think that makes sense as long as everyone's happy. Okay, so origin of goods. So as I said at the beginning, origin is obviously in the news a lot at the moment because we were just before Christmas, the trade and cooperation agreement between the UK and EU was agreed. And so this now sets the kind of rules of us trading between the UK and the EU. And in order to benefit from that, so this trade agreement is brilliant in that from day one it removes tariffs on all goods, but you have to be able to prove that your goods are either UK or EU originating. So lots of people are asking lots of questions about origin at the moment. So we're just going to go through some of the kind of fundamental principles just to hopefully get you a bit more comfortable with the topic. So in a minute, I'm going to talk, there's 2 different types of origin. So all goods have an origin. And the best way to think about origin is it's the economic nationality of a product. And it's that economic nationality that will dictate what, or can dictate what the duty rate is, whether or not anti-dumping duties might apply, or other kind of countervailing duties. And also certain restrictions and prohibitions might be directly influenced by that origin, as well as by the commodity code, as I discussed earlier. Again, just to reiterate that point I've made several times now, that where goods physically come from isn't necessarily where they originate. You do have to kind of go through a decision of, you have to apply some general principles to figure out what that country is. So broadly speaking, we have two principles. We have the concept of wholly obtained, so it's dug out of the ground, it's grown there, it's reared there. And then we have this concept of sufficiently worked or processed. So for those goods that are not wholly obtained, they will be considered to be originating from the country in which they underwent their last substantial transformation. So they're the kind of broad principles of determining origin. But then when we're talking about trade agreements and benefiting from preference under them, we do have to look at the specific rules under those trade agreements. If we could go on to the next slide. Okay, so as I said, we've got two different types of origin. So all goods will have a non-preferential origin. So as you saw on the customs declaration earlier, you have to declare what the origin of the product is, and that will influence some of these conditions here that I've already talked through. It's then a choice, and that's a mandatory requirement. So you have to declare that. Your goods will automatically get treated according to what that origin is. As an importer, you then have a choice as to whether you claim preferential origin under a trade agreement. So for example, if you're importing into the UK from the EU, we know that we have a trade agreement. You would then, we'd have to look to the specific rules of that trade agreement in order to understand whether you could benefit from preference. So with preferential origin, obviously there's an element of analysis required against the trade agreement and your product. And also there's some admin around obtaining proof of origin or certificates of origin. So I think I've seen a lot of confusion around this fact that there is a subtle difference here between preferential and non-preferential. Just because something is exported from the UK does not mean that it would be UK preferential origin under the trade agreement, or vice versa from the EU. And we've seen a lot of pressure being put on businesses to say this is UK preferential origin, when actually it might not be. And then obviously you've potentially got an issue at a later stage if you've incorrectly declared this. And then you would owe that duty to the authorities, or potentially to your customer, if that's proven to be incorrect at a later date.
Yeah, and just picking up on that, I think it's an important point to note, because if you're importing the goods into the UK and you're making a positive declaration or statement in your declaration that you're claiming preferential rates based on the supplier telling you those goods were of EU origin, and it goes wrong, or HMRC subsequently disagree and they turn out they weren't of EU origin, you as the UK importer are the ones liable for the customs debt. So if you think about that in contractual terms, is you're reliant on a third party's information to make a statement of which you will then ultimately be liable. So from a contracting perspective, I would recommend that you want to include appropriate warranties that your supplier is going to give you accurate and complete documentation, the documentation you need, and then also an indemnity that gives you some legal protection in the event that it turns out that the information they had provided you wasn't correct. And before Brexit, we have come across lots and lots of scenarios where that has actually become a real issue, and if it's not provided for in the contracts, then it really does become quite a complex dispute.
So I've just provided a bit of hopefully a helpful tool to facilitate some thinking. We don't have a huge amount of time for this webinar today, so we haven't got time to go into the detail the trade agreement, but hopefully these are some kind of questions and concepts that you need to be thinking about in the context of that trade agreement. So the first point, well, I guess even before we get onto this decision tree, is your product subject to duty? If it's not, then why are you even thinking about a trade deal? Because it's not relevant. And actually, I have seen that a lot of people submitting statements on origin and proof of origin for goods that attract 0% duty. Is just not needed. So first of all, is the product wholly obtained? If it is, then great. It's of preferential origin, a job done. Unfortunately, for most of you, I suspect it won't be as straightforward as that. So then within the trade agreement and within most trade agreements, not just the UK EU one, we have this concept of sufficient working or processing. So you need to get above that threshold of sufficient processing before you can even start to think about the specific rules in the agreement. So if, for example, you're just repackaging, or you're just slicing something, or you're just doing simple assembly, then sorry, that will never be considered sufficient enough to change that economic nationality. And therefore, if it's insufficient, then the product is not of preferential origin. And then, unfortunately, you stop there. If you do go beyond that threshold, then you have to look at the product specific rules. We talked a bit about this last week with Ian going through some of the supply chains. Now, there are different rules that will depend based on your product. So you might have values-based rules where you have to meet a certain threshold of originating material within your product. You might have change of tariff heading rules, or you might have process-based rules. So it really will vary depending on the sector that you're in. So you need to make sure you can meet that rule. If you do, then you've met the origin requirements. If you don't meet that product-specific rule, then there is kind of this final provision that's there that you can rely on if you need to, which is around tolerance rules. So this is either 10% or 15%, depending on the type of goods that you're moving. And this is the tolerance rule, so that for those that are just on the, you've got just a little bit of non-originating material, that means that you can't quite make the rule. And it's there to help businesses in those scenarios. So these are kind of generally the questions you should be thinking. Obviously, there's a lot more detail that we could go through, but hopefully that gives you a feel for the key concepts. And we'll talk through a few more of those. We've just got a couple more supply chains to go through.
So this is just conscious of time constraints of movements of goods between Great Britain and Northern Ireland now, or goods moving from Great Britain through Northern Ireland into the EU, has become hugely complex. And this is because the UK and the EU agreed that, both sides agreed that we didn't want to put up new physical borders in the island of Ireland. So Northern Ireland now has this, it's governed by the Northern Irish Protocol. The Northern Irish Protocol is separate to the trade cooperation agreement that was agreed between the UK and the EU. And the fundamental point under the Northern Ireland Protocol is Northern Ireland has dual participation status. So in respect of the movement of goods, it is still governed by EU VAT rules. So goods moving between Northern Ireland and the EU and vice versa are treated in the same way as an intra-EU movement for VAT purposes. And Northern Ireland also is part of the UK VAT regime. So the movement of goods between GB and Northern Ireland is subject to VAT. The complexity arises with goods that are kind of going into Great Britain is the EU has to protect its borders. So the way it does that is actually goods that are moving from GB into Northern Ireland are actually treated as an import into Northern Ireland, and there's a declaration requirement that comes with that. I won't go into all the details, but to put this into context, one of our most experienced, and probably one of the country's most experienced customs specialists when it comes to processes. He sat with a client last week to do 3 of these declarations, and it took over 4 hours. And that's because of the system that's being built to actually handle the declarations is a very inefficient system. So at the moment, it's moving goods between Great Britain and Northern Ireland is not easy. My recommendation would be is if you can do it, don't flow goods through Northern Ireland, because I think these issues will get ironed out, but things are just very, very complex at the moment. Okay, I don't know if there's anything you wanted to add to that. It really is. It's probably the most complex area, I would say, in terms of the post 1st January issues the business are dealing with.
It's complex because, like you said, there's new systems, and also because in many ways it's illogical because it's a domestic move, and I think people are struggling to get their head around it. But we've provided, just to answer another one of the questions that's on, so there's obviously going to be a recording of this, and the slides are going to be available. So there's a checklist here of key points to consider. So we'll leave that as the takeaway. And then if you've got any questions about Northern Ireland, then please do feel free to reach out and get in touch after the webinar. But the concepts around Northern Ireland are the same as everything else we've been talking about. There's an import declaration that's required. And so everything we've been talking about applies to that in terms of the key things you need to be thinking about. So what are the Incoterms, therefore who's importing into Northern Ireland? But then obviously there's various mechanisms you need to be thinking about in terms of whether you have to pay duty in Northern Ireland or not. So are your goods at risk, are they not? But yeah, so we'll leave that there.
I see another origins questions coming, but I think we'll pick that up at the end.
Yeah, we've just got a couple more supply chains to run through, and then we'll pick up that question because it's pretty relevant. To be honest, it might be relevant to pick it up now. So, so within trade agreements, we have various other provisions. So we've got those product specific rules that we were talking about in terms of change of tariff heading, change of value, etc. But there are also other kind of general provisions that we see as well. So the one that I just wanted to highlight here because it comes up quite a lot. So in this supply chain, we've got an import to the UK from South Korea, and then we've got and then the goods are stored in the UK and then they're exported to the EU. Now, both the UK and the EU have a trade agreement with South Korea. So in this scenario, if the goods meet the rules, you can claim preference at import, that initial import into the UK, but then nothing's happening to those goods in the UK, and then they're exported to the EU. So you can't benefit from the UK-EU trade agreement because nothing's done to them. They're South Korean origin, so therefore you can't benefit from the UK-EU trade agreement, but you also can't benefit from the South Korea-EU trade agreement because of this direct transport non-alteration rule, which basically requires that unless goods are in customs control, then they have to be directly shipped to benefit from preference. There are things you can do to mitigate this around customs warehousing, transit, etc., but it's just something to be aware of. And I know it's quite a bizarre concept, and this is where this whole concept of non-preferential, preferential origin comes in terms of these goods are still South Korean origin, but you're not claiming preference. And the question that's on the Q&A, it's exactly the same concept. So the question on the Q&A is around eyewear that's manufactured in France, and then it's imported into the UK, and then it's just assembled with kind of cases and cloths and other items that are added. And then it's exported all over the world, including to EU countries. And as you've rightly observed, you can't claim UK preferential origin because you don't meet this sufficient processing principle. So in this scenario, I mean, you need to analyze it properly to see what the origin is. But if we assume that the origin is France, so when the goods are going back into the EU, they're still French origin, but you just can't claim preference. So in that origin box, you would declare France, but you would not be claiming, the importer would not be claiming preference. So similar kind of concept as what we're talking about with the South Korea trade agreement. if we go on to the next supply chain, so this is a really common one. This is the last supply chain that we're going to talk through. We have goods that are coming from the EU into the UK, and then going on to the Republic of Ireland. So in the UK, these goods are often just being stored, or they might just be some really basic operations, so kind of repacking, breaking down bulk, etc. in the UK. So similar to what we were discussing before, you can't claim preference, and the minute that those goods leave the EU, they've lost their union status. So they've exported from the EU, they're in free circulation in the UK. So then when they go back into the EU, then potentially duty is payable because nothing's been done to them, but also they don't have their union status. So this is affecting loads of businesses at the moment, particularly in the food sector. So the options under consideration, a combination of transit and customs warehousing. So these are two reliefs, two customs procedures that are being used, and also return goods relief, which was not originally designed for this kind of supply chain, but is being used to mitigate that impact. So we've set out here the key criteria to benefit from return goods relief. So these are goods that have been in free circulation already in the EU when they were exported. They've not been imported to be, they've not been exported to be repaired or processed, and then they're re-imported within 3 years. There are a lot of admin requirements around using return goods relief, around having the original export declaration. And in a scenario like this, where you've got a different country of export and re-import, then you have to have something called an INF3 form. So there are various challenges, I would say, that are being worked through at the moment in terms of how this is practically managed. But Irish Revenue are heavily involved in these kind of discussions. So there are ways to mitigate this if you find yourself in this situation. And then just a final slide, which I'll just touch on briefly. So as you kind of appreciated through quite a lot of what we've said, one of the biggest challenges that businesses are facing now is that there's a huge increase in terms of the volume of declarations, the amount of data, and one of the most common issues that businesses have is that one thing we haven't mentioned actually, which is remarkable in the past hour, is that there's a cost associated with customs declaration. So agents charge anything from kind of £35 to, I mean, I've heard kind of £85, £100. So these declarations are expensive. So there are ways that you can do declarations yourself through authorizations and through the use of technology solutions. So lots of businesses are thinking about ways that they can use technology solutions in order to both manage their data but also to minimize their costs. I think often when people hear kind of technology mentioned, then they think it's super expensive and, you know, lots of change, etc. But there are lots of affordable solutions out there. And if you've got lots of cross-border transactions happening, if you've got a lot of duty that you're having to pay, and if you're needing to use some of these reliefs like return goods relief to optimize your supply chain, then absolutely it's worth thinking about ways in which you can use technology to benefit you, and to outsource some of that in order that you can be more efficient.
Thanks, Kate. So just bringing all that together then in closing, we just thought we would do the common themes. So I would say Incoterms disputes, like we said, that's really, really common just because of the pushback of people, customers saying they want goods delivered DDP. Classification of goods, because that can drive your duty rates. As I said, trading with Northern Ireland, just because of the complexities and people trying to get their head around the reporting associated with it. The interpretation of the rules of origin, because obviously that can determines whether you're entitled to claim preferential rates under the trade cooperation agreement. EU suppliers charging VAT. This is coming up a lot. And This is just, there's no rhyme or reason to it. There's no consistency to it. It just is, I think, being driven by a lack of understanding of how the new rules impact EU businesses. Seeing a lot of incorrect and misleading advice in the market. People being recommended to do stuff that just isn't necessary, and actually is very expensive and won't really provide the solution they think it's going to. We covered return and repair goods, and generally problems with obtaining EU VAT registrations, the length of time it takes, the requirements to actually get a VAT registration, and how to manage during an interim period whilst you're waiting for a VAT registration. Things to look out for. So I said I would cover it. So on the 1st of July for B2C supplies, there's some quite significant changes coming in the EU. There's the introduction of something called the one-stop shop. And this is going to replace the current or existing distance selling rules. So at the moment, if you're selling goods within the EU to non-business customers, that means subject to exceeding a threshold, which can be between £30,000 and €30,000 and €100,000. You have a requirement to VAT register in that member state and charge domestic VAT. So in theory, you could have a requirement to have like 27 EU VAT registrations. To simplify that, from the 1st of July, they're introducing this one-stop shop. So part of that is the threshold's going to reduce down to €10,000. But rather than having to register in every member state, you can elect to VAT register in one EU member state, and through that single registration, you will pay over and account for all of the VAT that you've collected on the sales to the consumers all across the EU during the relevant period. What that does mean from a systems perspective is because then VAT has to be charged at the correct rate for the member state in which the customer belongs at the point of sale. So from a systems perspective, you have to be able to identify where the customer belongs, what's the rate of VAT, and charge and collect that VAT, because you're also required to issue them with a VAT invoice. The other change that's coming in is there is introducing something called the import one-stop shop. So if you're a UK business, non-established or haven't got an establishment anywhere in the EU, selling to EU consumers, if your goods are under 135 euro in value, you won't be required to pay any import VAT or duty if they're dutiable when they enter the EU. What you'll do is, again, you'll elect to have a registration in one EU member state. And what you'll do is, rather than paying import VAT at the point of sale, you'll charge the amount of VAT, output VAT, that's payable in the country where the customer belongs. And then each period, you will submit a single return for all of the VAT that you've collected on all those sales and remit it through a single return. So it's intended to simplify matters. If you sell goods that are over 100, so I should mention it's 135 euro consignment value, not individual item value. If the consignment value is over 135 euros, then it is potentially subject, well, it will be subject to import VAT and duties, but there is an additional simplification that can say that you can use an agent to basically collect all of the import VAT payable for you and pay it over to the tax authorities on your behalf. So there are two simplifications that are intended to reduce down the administration burden for businesses that are selling to consumers in the EU. The other thing I just would raise as a cautionary note is that we are starting to see, and I think we will increasingly see, EU tax authorities looking at and challenging whether UK businesses create what they're doing, or the activities they're undertaking in the EU create a fixed establishment. And there's something for services that's called the use and enjoyment provisions And basically that says, so I've come across it recently, if you're a UK business and say you've got an advertising, supply advertising services to a US business, and that's where your contract is, but some of those advertising services are actually used or enjoyed in, say, Spain, the Spanish tax authorities are now saying, hold on, we want some VAT on those services that are used and enjoyed here, and that can create some new issues as well. So I think we will see this increase just as tax authorities look to increase their tax yield, and particularly as they focus more on what UK businesses are doing in the EU. So that brings to an end our presentation. So Joe, I'll just hand over to you, I think.
Thanks, Neil and Kate. Yes, unfortunately, we've overrun a little bit and we don't have as much time for questions as we might want normally, but there are a couple of things I've picked up on throughout. Firstly, there was just a comment, I think, in the chat around companies not shipping to the NI. I'm not necessarily sure I heard it like that, but maybe you guys want to address that in terms of what we're seeing and shipping to Northern Ireland.
We are seeing real practical issues because of these new declaration requirements. We are aware that some of the major kind of freight companies are actually just refusing to do those declarations because they're just too complicated to do. So we are seeing practical kind of barriers to people moving goods into Northern Ireland. So yeah, it is there, and it's to do with this this new declaration having to be on the UK trader scheme. You know, the fact that the trade support service that HMRC have set up, you know, isn't working as well as it could. It's teething problems. I think there will be solutions, but there are undoubtedly big teething problems with moving goods into Northern Ireland. But we're not advocating to stop shipping to NI. Just to clarify that. No, not at all. No, not at all. And then it's just looking at, are there alternate routes into Northern Ireland that can help circumvent those particular issues that are arising at the moment. And I do think the issues will get resolved. I just don't think it wasn't envisaged when the rules were put in, just how it's the system that sits behind the declarations that's the issue, not the declaration itself. Okay. And I think you said we'll come back to the B2C terms. I think you covered that at the end. Yeah, covered that one in July. There's one other question in the chat I'm not sure we got to, which was where they say the forms that I've seen for inward processing required commodity code for each product. We have 200 products, but we don't know which ones are coming back. Do we have to register all products? Yeah, so it is at the commodity code level, but HMRC require it to 8 digits. So that might help you because that might reduce down the different numbers. So it's not at SKU level that you have to apply that on the form. It is at 8-digit commodity code level, which doesn't sound very different, but actually often when you look at it, it cuts down the number of products. But you do have to make sure that those commodity codes are on your application. Otherwise, you might find that you would be in breach of your IP authorization if you imported something that you hadn't been authorized to import into that regime. So often that part of the application, in my experience, is often the most challenging in terms of kind of, or it can be for businesses figuring out just what it is that they need to declare. But obviously it's really integral because that's how HMRC know exactly what it is you're declaring. Thanks, Kate. I think we've pretty much covered the questions in the chat function. Yeah, there was just one that's really quite timely and topical, actually. I've just seen a pop up of, are government grants still available for documentation trading? I believe it was actually yesterday that the government announced that there is a fresh round of, I think it's about £20 million worth of funding available for training and actual advice to do with new customs requirements post 1st of January, and it's capped at, it's up to £2,000 of funding per application. So yes, there is some grant funding. It's not as generous as last time, and it's a bit more restricted in terms of the conditions, but there is some funding available.
Thanks, Neil. So like I said, I think we've covered most of the questions. Clearly we're here if anything else comes up or you think of after the event, do let us know. I guess it would be good to try and close with a bit more of a catch-all question before we depart. I mean, out of everything you've discussed today, you know, there's been a lot of detail in there. Thanks for that. What have you seen as the biggest thing that's catched most businesses you've spoken to out? If there's one thing that consistently comes a lot that seems to be catching businesses out, what do you typically see?
It would be the indirect customs agent requirement in the EU. That's one that I think caught a lot of people out, and that's because, to be honest, I think there was a real lack of understanding and communication by suppliers of those services ahead of Brexit, ahead of the 1st of January, and it was a case of goods were just arriving, and EU agents were just simply saying, well, no, either we're not prepared to act as an indirect representative, or you know, we'd be happy to do it, but our insurance says that we can't provide that service. So I would say that's the biggest issue, or the most common issue that we've come across so far.
Kate, anything to add before we wrap up?
Yeah, I guess another key is that with the trade agreement, I think lots of people assumed it would be like a customs union. So once goods are in free circulation, you can just benefit and it would be quite easy. But obviously trade agreements are a lot more restrictive than that. So I think the admin around both that analysis element and also the paperwork requirements, I think that's caught quite a lot of businesses out as well. And with those supply chains that we looked at, I think people have got duty exposure that they just didn't anticipate that they would have.
Excellent. So, well, thanks again. Thanks again, Neil and Kate, obviously, for delivering this. I think there's quite a lot of technical detail in there, so it may well lead to some further questions that we need some clarification on. Just a reminder to everyone still on the call, we have the next or the final in our series of these webinars on the 31st of March at the same time. That session will be covering all things legal, so contracting, for example, employment law, so some of the legal implications that come out of the deal. Thanks again to everyone, and hopefully we look forward to seeing you then.